depending on what the Fed does and says,
Mhm.
what's the likely implication scenarios?
After the Jackson Hole meeting and the most recent inflation numbers, it seems that this elevated rate hike expectations are going to last for a while. It now seems that the Fed is in line for another 75 basis points hike in September, followed by possibly a series of 50 or 25 basis points, taking the terminal rate to somewhere close to 4%. Now, this is a wildly shifting narrative. In fact, if we were to think about this terminal rate 6 months ago, it would have been nowhere close to 4%. Add on top of that the Fed's QT, which is actually accelerating to $95 billion in September and likely to remain there for the foreseeable time horizon. It means that liquidity is being sucked out from the global asset markets, which would have an outsized implication for flows into Asia. We've already seen that in the first 9 months out of Asia, about 64 to $65 billion have been taken out. And it looks like it's likely to stay that way for the foreseeable time horizon. So, the implication of Fed and possibly other developed market central banks' action is clearly not positive for Asian asset markets. We have already seen that, and we have to brace for some more time, to kind of take this into account.
Hmm. Yeah, the recent flows also seem to suggest that, I mean, save for maybe India, I don't know
Right.
if Taiwan kind of featured last week, but otherwise, save for India and a very few other OSs, the outflows continue. Now, what happens in the event of a combination of QT plus maybe a hawkish Fed and plus maybe geopolitics continue to rule? Do
Mhm.
you reckon that these could get exacerbated, or at some point of time there will be some bit of realization that Asian valuations have certainly fallen, not India, but Asian valuations have certainly fallen?
Right. You see, the problem with Asian valuations, and you highlighted the geopolitical risk that is an added variable now. The Asian valuations are being dragged down predominantly by North Asia. If I look at China or Korea, they're trading at record low valuations now. And understandably, because these markets in North Asia, like Korea and Taiwan, they're globally linked. There's a concern about recession in the European region or in the United States. So obviously, corporate earnings are being dragged down in those markets. China has a problem of its own, which is more domestic in nature, pertaining to the zero COVID strategy and the regulatory risks across different sectors. So a combination of this has actually dragged down the Asian average, while the ASEAN markets and India are faring relatively better. We have also seen flows actually gravitating towards those markets, particularly if you look at over the past 3 months, say since July, there is this sell North Asia buy India trade which has been going on amongst FIIs. It might last for a while. The only concern for India is relative valuations, which is a combination of India staying where it is at an elevated valuation level, while the rest of Asia, particularly North Asia, being dragged down. So, for now, we think that this flows gravitating to Asia and the FII's targeting an overweight stance on India might continue. The only thing we have to watch for is a potential outperformance of North Asia, which may not happen right now because there's a this narrative of recession in the developed markets has to vanish. But we have to watch very carefully after the policy meetings in China in mid-October, because that's when moving ahead of the zero COVID stance and articulating strong economy boosting measures could actually come through.